Wall Street might be too optimistic on retail stocks. Goldman Sachs estimating 24% earnings improvement in 2023. But Brian Sozzi says the street might be ignoring some key warning signs for retailers. That's where we find Sozzi's take.
Yeah, you do get the sense that the bad news is continuing to pile up in the retail space, and you'll probably get more bad news from the likes of Bed Bath & Beyond when they report earnings later this week. Maybe not necessarily Nike when it reports after the close today, but nonetheless, good little nugget inside of a note by David Kostin out this morning, looking at, like you mentioned, Brad, earnings earnings estimates for next year for consumer discretionary stocks up 24%. Sales expected to be up 10%. Now, Kostin is arguing that Amazon and Target, they're starting to see estimates come down. You look at Amazon, earnings estimates year to date have been taken down by 33%, Target by 19%. I think Kostin is arguing this is a leading indicator to what you could see from a lot of companies, not just retailers and other consumer discretionary companies, as they report second quarter earnings coming up in a few weeks. And this could be potentially a negative headwind for stocks. Now, going back to retailers real quickly, I made a quick little list or a checklist of some problems with retailers right now. And here's a very simple checklist as you prepare and do your homework for earnings season. One, slowing job market, and that is likely to impact retailers in numerous ways. Stubborn inflation. Obviously, retailers like Target are being hit by higher diesel prices, and of course, their consumers are being hit by higher gas prices. Bear market in stocks. What does that mean for purchasing, let's say, luxury goods or home goods, even at a Target? Bloated inventories. Target really set that warning signal out there a couple weeks ago with its concerning conference call. And last but not least, slow-moving executives. I think you have a lot of retailer executives in the space, at least ones that I've talked to, saying they're probably a little bit behind the curve on this consumer spending slowdown, and they're going to probably have to move aggressively, like Target, even like a Walmart, to mark down their inventories. Last but not least, my take here is this. You have to watch earnings trends moving forward. It's one of the most important signals, I think, in the market at this point in time. An argument could be made, and we were talking about to Keith Litter earlier on in the show, earnings estimates have not come down enough to account for slowing economic growth.
But here's my big question. Do stocks bottom before earnings do? Mm-hmm. So in other words, even if earnings estimates start to come down, it's well within the realm of possibility that stocks could bottom before then. It's
true,
right?
You make a good point. You could make the point we're in a bear market, obviously, right now, and that is priced in earnings estimates and sales estimate downgrades. But again, look, you see these estimates coming down from Target in recent weeks, and the stock has still been under pressure. So that's probably the other side of the coin.
Well, we'll see what happens.
We'll be here to report on it, though.
Yeah, I mean, when you talk about nimble executives, Target, I think, gets some points for being aggressive
Absolutely.
on that front, even though it's been punished for it, to your point also.